Invest in historically positive days during bear markets. Our collaborative research partner has identified certain cyclical days that make investing sense to hold equities even during bear markets. Welcome again to The Rare Advisor. I have asked Kevin Roskam to join me once again, most specifically because I'd like to talk about the strategy that we have deployed for adding what I'll call collaborative research partners to USA Financial Formulas. It allows us to expand our reach. It allows us to create specialization in areas that we do not personally necessarily specialize in, but at the same time, it kind of enhances and augments a lot of the existing models that Formulas has had for many years, but we've been able to branch out and bring these partners in. Most specifically, I'm talking about Just Capital, which is a dominant player in the ESG market. They are unique in that arena because they're actually a nonprofit organization that ranks the Russell 1000 companies based upon how just they are. And it literally creates a scenario where they will create what they call the Just 100 and the Just leading industry leaders and things of this sort, where they go through a series of who are the stakeholders, be it the employees, the stockholders, the community, and so on and so forth, the customers, obviously. And they create this ranking system of how just they are based on, again, the environment and all the other things that go into being a just company. And so we're able to embrace the ESG arena in a way that it's honestly never been embraced before from an investment standpoint. So super cool there that we've got those models out now with our research partner, Just Capital. Our next research partner would be Value Line. Many of you know the Value Line name. It's a kind of a historic, not kind of, it is a historic name in the financial services world. And we have embraced their timeliness ranking as well as their other tools to identify the holdings that they suggest should take place inside of various models based upon the research that they are bringing to the table for us. And then again, just like with all of our research partners, we take over the administration and we execute based upon their research and direction. And then in addition, and finally, at this stage, we have Sherman. And with Sherman, they have become a very good partner because they take into account a lot of risk management, very similar to our approach, whereas to contrast against Value Line and Just Capital, not quite as risk management oriented, but they are very formulaic in their approach. Where in Sherman's world, you'll find that it is kind of dominating in the ETF arena. And it does take not only a formulaic approach, but it also incorporates a risk management approach within that as well. So they've made for a very kindred spirit here at USA Financial Formulas as well. So Kevin, that was my overview to kind of catch everybody up. But I think today our real concentration, our plan of attack was to kind of pull back the veil, kind of pull back the curtain, if you will, on what's going on with the relationship with Sherman. It's become very popular very quickly, and has been just a very successful relationship for us in terms of a research partner.
Yeah, thanks for having me, Mike. It has been really exciting to see. It's been something that for the folks that have been using USA Financial Formulas for a long time, a lot of the story is familiar. What we have done for so long is part of that unemotional management that we adhere to is a monthly evaluation. And for many of our strategies, the monthly evaluation has treated us well because we've always been focused on making sure we're making an unemotional decision, making sure that we're making a timely decision. But as we've seen with market volatility over the last several years, sometimes volatility moves so quickly that it's hard to manage. And Sherman doesn't do a perfect job either, but they come at it from a different angle. And there's two sides to every type of investment strategy. There's the investing side and there's the risk management side. And Sherman has, a very, very unique approach on the risk management side and a very solid approach on the investment side. Nothing really exotic, but something that's very functional, very, very solid. And so,
And easy to
with
understand for the investor.
exactly right, yeah, easy to understand. And so what they're doing on a quarterly basis on the investment side is they're choosing ETFs based on their measurements, which, to simplify as much as possible, is based on relative strength. They're looking at 24 different asset classes versus the Russell 1000. I'm sorry, the Russell 3000, and they're looking to pick, the somewhere between 5 to 9 ETFs, and the plan is to hold them on a quarterly basis. Pretty simple. What I get really excited about, though, is how they're managing risk. We're very familiar with market trending, and we know that a lot of people came after us in that market trending world, and a lot of advisors have been burned by it. The old phrase was, market trending works until it doesn't. So with Sherman, they use a market indicator, a trending tool. They call it the bull bear indicator. And it's very familiar to the guys that are used to working with USA financial formulas. It trends the long-term S&P 500. It looks at that long-term trend, and it doesn't move very often. The other thing they do that is really exciting to me, though, is they have something called the BOSS indicator. It's the balance of strength signal. And the easiest way to describe it is they're looking really for the balance of strength within the marketplace. And so they're looking at, kind of the ebbs and flows of momentum, the ebbs and flows of strength in the market, and they measure different asset classes versus the strength of cash. It can be way more complicated, and maybe that was too complicated. The exciting thing is that they do this every day. And so even as you're getting your investments, your ETFs, initially for a quarterly hold, at the close of business every day after the market closes, Sherman goes in and they record that bull bear indicator, and they record that balance of strength signal. And so, especially with what we've seen in the market and the world for the last 6 to 9 months, it's been a huge draw for our advisors and for their clients to say, listen, we know this is a long-term investment, but let's verify on a daily basis if we should continue to be invested in this market with this volatility. So, it's been, like I said, it's a familiar story in terms of being unemotional, tracking indicators, but it's an exciting addition because they're doing it on a daily basis, and that's not something we've had on the platform that we've been able to offer.
Yeah. And I agree with you. I think one of the intriguing ways that they're doing risk management, and I guess partly is because it has such a visual capacity to it, is, as you mentioned, they're kind of measuring the market and the various asset classes against cash. And so if you can imagine, these things kind of stacked up. If cash is climbing, then they would interpret that as being a bad thing. That in terms of equity performance. So if cash is climbing, that's the kind of thing that would trigger you to say, I need to go to a defensive position, or would trigger the model, I should say. You don't have to do anything. You would trigger the model to go to a defensive position. And on the other hand, if cash is declining in that list, it's working its way down, or it's at the very bottom, then the opposite is true. That they're now saying that the market momentum, the relative strength, as you point out, is growing, is increasing, is distancing itself and surpassing and climbing farther ahead of cash, and therefore you would remain in those equity-oriented investments. But if cash is climbing against them, then that tells you the opposite. And one of the things that I also think is unique is what occurs when you do take on a defensive position. There are periods of time in which at least some of their models would actually invest based upon the history of what occurs during those time frames. Do you have a good easy explanation of that?
Yeah, I do. So, it's another one of those things. And just as a reminder too, with our partners, what we are doing is we are really the mechanism to enact their research. And so what that means is that, Sherman will send us the signals and we will act on those signals. So we are really, in terms of a research partner, we are doing the lifting and they're telling us what to lift. So, when they go to a defensive position, when they tell us, okay, either one of the indicators has gone negative, in our strategies, what happens is they go to something called the calendar effects model, and really simple. Sherman has done the research, years and years of research to determine that there are times in the market around the stock market trading calendar where it's advantageous to be invested, usually 5 to 10 days at a time, but right around when the quarter ends, when companies have to report their quarterly earnings and those types of things, when the options expire. There are times when, and it's about 28% of the year, 28% of the time, where this calendar effects model will sneak into the market in terms of equity ETFs for 5 to 10 days at a time. The other 72% of the year, it's going to be in money market. It's
So
kind of
even
waiting for that opportunity.
so if you're using this as a defensive scenario, then what you're saying is even if it's a bear market, even if we're in a defensive position, we're out of equities on a generalized basis, they will actually jump into equities in these short little windows of time because their research tells them that the timing of it historically tends to do well in the market, even when it is a bear market.
Right. Right. And of course, past performance doesn't guarantee future results. But what they've seen is that, like I said, when options expire, the people who own the options have to act. There is forced buying and selling at that point. And because of that forced buying and selling, it's only for a short amount of time. Theoretically, you'd like to buy before to be prepared when the action happens, and then after the action ends, you sell out. So it is on an exact calendar. That calendar does not change from year to year, but it's a neat opportunity. If you think about 2008, you know, rather than being out of the market all year,
Right.
which certainly was better than being in, what they show is that you had the opportunity for, if you were slipping in and out, again, as options expire, as new earnings reports come due, as all of these little things, these events happen, if you were just in the market during that time, you actually had the chance to gain ground instead of just sit still. And so it's an intriguing strategy, and it's really for if you're out for extended periods of time. This gives you the chance to maybe see a little bit of growth.
And I think that's a great example because it also shows you the power of what we started this conversation for, which means that there is so much data out there, and each of these research groups brings their area of specialty into the equation, and I don't know of anyone who has dialed in the specifics of what you just described the way Sherman has. I don't think you could match that anywhere else in terms of the detail of how they've got that structured, so that you
Right.
can use that as a defensive play that allows you to get some potential uptake in the market, even during a bear market, based on the research of all of their timing of this stuff. So really, really interesting, and it's a great kind of reveal of why we're working with these research partners.
Yeah, well, and you said it. They've got expertise that we don't have the time or even maybe the desire to develop. I mean, why should we develop it when we can leverage this partnership that they've been using? Research that they've used, that they've had success with, and like I said, that aligns with a lot of our philosophies. I think it's just been such a natural partnership. The relationship has been. It's like we've known them forever. I mean, even though we've known of them certainly for as long as I've been with USA, we've known of Bill Sherman, but but this relationship feels like one of those deals where you've known them,
Yeah.
boy, forever.
But
It has really been a nice match.
getting kind of into some of the personal side of it, but it's in terms of the people, our team clicks really well with their
Yeah.
team. It's a great working relationship, but also I think what you're kind of touching on is philosophically, they are very much aligned with our way of thinking in terms of the importance of risk management, the formulaic approach to investing in equities. Now they do it a little differently than the organic formulas models do, what we call port formulas, which tend to be more stock based for the most part. They tend to be a little more ETF based, but the philosophical approach to how to do these things and what makes sense falls right in alignment with the overall formulaic trending message that we tend to preach.
Yeah, I think so. That's why, you can tell I get excited about it, but it is because it is so aligned with what we do. And I don't think what we do takes away from what they do.
Yeah.
In terms of a diversity, and we talk about multi-dimensional diversification on the exchange platform. That's something we can achieve because there isn't the overlap. I mean, our indicators are monthly, generally especially when we're doing this at the stock level, whereas they're doing it really at the asset level in terms of getting in or out. It's a really nice fit.
Yeah, it really is. So that's again, it's been a way for us to dial in more specialty into the portfolio. It's filled great voids. I would encourage you to take a deeper look at this if you haven't already. Kevin and his team can help you in that regards, but it's a great way to expand not only what we're doing here at USA Financial, but what's really important is as a financial advisor, it's adding powerful tools into your toolkit so that you can put this stuff into the portfolios that you're building on behalf of your clientele. So thanks as always for tuning into The Rare Advisor. Please again, like, subscribe, and stay tuned. We'll be back again with you in the near future. Thanks for everything. Thanks, Kevin.